Welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Friday, July 19th. And joining me, as always, Dr. Orphe Divounguy, PhD, economist. Dr. O, I'm over the moon about your column every Monday at the Center Square. I think you're mapping important things out. And here we are. We're taping this on Friday, July 19th, but we're going to talk about the week ahead. What's on the docket this week, my friend?
Lots of housing stuff this week.
Anything in particular stick out inside of the housing data that's going out this week?
Yeah. The fact that basically mortgage rates kind of eased in June a little bit. They eased more in July so far. We're going to get the June data, and all of the housing data that I'm seeing so far shows basically that sales slumped, despite mortgage rates easing, but inventory did not rise all that much, right? Remember, when sales decrease, when people don't go out and buy the homes that are being listed on the market, that inventory tends to accumulate. What we see what I saw in the Zillow data is that inventory did not rise all that much. It was 22% higher than last year in May. It's about 23% higher than a year ago in June. So it just barely increased. And the reason it barely increased is because fewer people actually went out and listed their homes in June, listed their homes for sale in June. So new listings actually fell. They fell about 9% in June.
Can I pause you there for a second and ask you this question? That's somewhat unusual, right? I mean, and we think about, like, I'm not in the real estate business, right? And I'm not, I'm not a real estate investor. But I mean, as a consumer, as just a retail buyer in the market, right? I mean, there's, the end of January and then the beginning of the summer. Those are kind of the two big peaks that I look for. I think some of the best, most interesting new inventory that I've ever looked at or considered has come on kind of at that point, and certainly in that inside of that window. You're saying that it's down 9% in June year over year?
Yeah. So actually, this is interesting. I looked back 2019, 2018, and before the pandemic, yes, basically new listings would peak in May and actually decline in June. So to me, it looks to me like sellers are back to the old kind of seasonal pattern.
Right. Get out of this house. Let somebody come into it. You get into your new place before the school year starts in your new town or wherever. And so does the buyer, and everybody's happy.
Exactly. So sellers are back to that. They start listing in January, February, new listings go up. They peak in May, and then they start coming down for the rest of the year. And buyers also just pull back, right? Because basically they're like, oh, there's no fresh listings hitting the market. The listings that are there are kind of stale. So, I'm done with my buying usually in the summer. And what we're seeing this year is, yes, same thing happened. New listings up, peaked in May. They fell in June, and inventory is climbing, but climbing at a slower pace because there's just not a lot of fresh listings hitting the market anymore. Or at least that's what we think should happen, will happen for the rest of the year. But if you think about that, right? By the way, we get new home sales on Wednesday. And if you think about that, what it means is that the door opens up for newly built homes, because ultimately builders will continue to build. They have a ton of homes that are being built right now under construction. They have homes that are just being finished. There are homes that are hitting the market. They have almost 9 months worth of inventory on the market already. And so with fewer existing homes coming on the market for the rest of the year, it just opens up the door for new home sales, especially if mortgage rates continue to ease like they have in July. So with that said, what all of that tells me, that new home sales, even if existing home sales decline in June, new home sales will either not decline as much, or maybe actually increase a little bit, because basically that's what's left. That's what's fresh. That's what's hitting the market. It's newly built homes. So I think that's going to be interesting to watch, whether or not builders get like buyers go ahead and push forward with like a late season push, right? Because mortgage rates fell a little bit, and that basically builders benefit from it because they're the ones with the fresh inventory, you know?
Freddie Mac's rate, I just checked it just so nobody has to pause and look that up anywhere else. As of yesterday, the 18th of July, we're taping this on the 19th, 6.77%. So in better range. Hey, looking ahead at the other stuff that's on the calendar for this week, GDP comes out on Thursday morning. So what are you thinking? What are you thinking? I'm trying to find like the kind of the highlights inside of the calendar. I think GDP is always, it's
it's a look in the rear view mirror, right? Because this is Q2, right? And it just takes that long to get these statistics, these numbers done at the Bureau of Economic Analysis, right? So the official government data, guys, are going to take a little while. And they come out with GDP for Q2 it's expected to be at 1.4%. But when you look at GDP now, this Atlanta Fed nowcast, it's got it at 2.7% for the second quarter. So it's probably going to show GDP increasing by more than most people expected to have in Q2 of this year, which I think is interesting, right? Because in Q2, inflation really started to come down, right? But the big question is the come down in inflation, the decrease in inflation, due to a slowing economy, a consumer pulling back, so demand stuff, or could it be that you saw continued improvement in supply chains that has helped to push prices lower? I think that's really interesting. So in 2022, it was mostly supply pressure easing. 2023, more supply pressure easing, and some demand, some reining in from consumers. We also saw the last PCE numbers showing basically income was increasing really rapidly, but consumers had basically held back. They were saving a higher share. They were now starting to save a higher share of their income. And so, of course, demand kind of the consumer not necessarily falling apart, but the consumer basically just restraining it like being a little bit more restrained in a decision to go out and spend. And I think that's a good thing. I think that's good news.
Well, and that makes sense. I mean, I think it's what, once, like, we've had these conversations ongoing. I mean, you start tapping your savings, you start, you just have to stop. At some point, you just have to stop, and you have to reconcile your personal economics.
And also, it's like, you're thinking the labor market's still pretty strong, so it's supporting consumers. So consumers are still okay. I mean, especially if you own a home. I talked about this before. If you own a home, if you were, you saw your housing wealth increase, if you're invested in the stock market's done relatively well, really well for you. If you're employed, you have a job and wage growth is pretty high, now outpacing rent growth. Your monthly housing costs are really low because you probably have a low mortgage payment. You're okay, right? And as long as you keep your job, you're okay. But with the labor market showing signs of cooling down, and I saw a note earlier this morning from the Federal Reserve Bank of San Francisco that basically shows like labor demand and supply are close to balance. Like you're now back to like pre-pandemic balance between demand and supply. We had so many more jobs than we had workers. That's back in balance. And so workers can't just quit their jobs anymore and switch around. They can't do that anymore.
I've heard from one of my sources that quits are down in a pronounced way.
Absolutely. Nobody's doing that anymore. So with that happening, right, with the unemployment rate rising from 3.6% to 4.1% over the past year, expected income has fallen, right? People are not like out there thinking, oh, I'm going to keep getting raises and quit my job and go for another one. No, it's not happening anymore. And so when expected income falls, people start to say, okay, it's a good thing I still have a job. I'm going to stay put and I'm going to start saving just in case I lose that job because the unemployment is rising. I can't find a job easily anymore. I need to shore up my savings. And so that's what's happening right now. And as people do that, they spend less, right? They spend a lower share of their income. And so inflation continues to moderate. And so that is, I think, what's happening right now. And that's probably what we're going to see in the PCE data.
Well, those are all things that you can look forward to seeing in Dr. Orphe Divoungui's column, Everyday Economics, at thecentersquare.com. Ask your local newspaper to start running the Everyday Economics column each week. Get you and your community in the loop. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.